In February, global stock markets experienced significant volatility, influenced by various economic and geopolitical factors. As far as the U.S. stock market is concerned, the S&P 500 index recorded its worst day of the year on March 3rd, declining by 1.8%. The tech-heavy NASDAQ composite dropped 2.6%, while the Dow Jones Industrials fell 1.5%. These declines erase gains made earlier in the year, with the NASDAQ suffering a nearly 4% drop in February alone, marking its most substantial monthly decline since April of 2024. Why is this happening? A lot of it has to do with the impact of tariffs. The increased market volatility coincided with President Donald Trump's announcement of new tariffs, a 25% duty on imports from Canada and Mexico, and an additional 10% levy on Chinese goods, supplementing an already existing 10% tariff. These measures raise concerns about escalating trade tensions and their potential to hinder economic growth. In response, both Canada and China imposed retaliatory tariffs on U.S. products, including soybeans, pork, and beef. This tit-for-tat exasperated fears of a global trade war, contributing to a 3-month low in the U.S. dollar and significant declines in major stock indices. The tech sector faced notable challenges, with companies like Nvidia experiencing sharp sell-offs. However, some tech giants, such as Meta and Netflix, demonstrated resilience, remaining within their buy ranges despite the broader market downturn. Conversely, sectors like information technology struggled, with the S&P 500 IT sector tumbling near the end of the month after concerns about U.S. artificial intelligence companies' capabilities to deliver cost-effective performance. When we look at economic indicators, there's a mixed bag. Economic data released during this period has been both positive and negative. Manufacturing data came in weaker than expected, indicating rising inflationary pressures. The Federal Reserve Bank of Atlanta's GDP Now model forecasted a 1.5% contraction in U.S. GDP growth for the first quarter of 2025. Potentially marking the first quarterly economic contraction since early 2022. Making sure that you have a plan that covers all 5 key critical areas of the retirement-ready roadmap is so crucial. Because when we're hitting market volatility, that hits the investment side of your plan. But what are you doing in the other areas like income planning, tax planning that can offset some of the declines and some of the nervousness and some of the angst and fears that you might be having? Bottom line, stay calm, stay diversified, and don't let the short-term noise derail your long-term plan.